A technical signal is flashing green across the board, but one sector is bleeding while others surge. The question isn't whether to buy. It's whether the rally has proper funding behind it or if we're seeing a fever spike before the crash. Every portfolio needs to know what's driving the pulse today. The broad indices are running hot with technical breadth confirming strength across the board. S&P 500 gained 1.48%, while Nasdaq jumped 2.13%, showing coordinated buying rather than isolated spikes. Tech speculators responded aggressively. ARK surged 3.64% and MAGS climbed 4.05%, confirming that speculative appetite is returning alongside earnings beats from Microsoft, Amazon, and other big tech names. The data confirms this isn't a one-day anomaly. The buying wave has depth. Capital allocation shows clear preference for growth over safety. IWM, small caps, gained 2.21%, while Canary, regional banks, added 1.37%, indicating confidence flowing into both mid-cap and bank sectors. The AI spending boom is hitting Wall Street metrics. Capital expenditure patterns suggest companies are still investing heavily in infrastructure despite valuation concerns. Our metrics indicate the credit channel is open. Lenders aren't pulling back, and corporate balance sheets remain intact enough to support growth spending. Volatility products are cooling off, which signals markets see this rally as sustainable rather than panic-driven. UVXY dropped 2.8%, while VIXY fell 1.69%, meaning hedging demand is receding into the background. However, the 10Y Treasury, still yielding 4.69%, provides a floor. Investors can park money here if stocks start coughing again. The fear gauge isn't flatlining but showing controlled respiration. This is healthy fear, enough to keep attention focused, not so much it paralyzes action. Energy is the outlier today. Crude oil crashed 5.26% as geopolitical headlines fade and technicals reverse a prior rally. Oil's collapse means cost pressures are easing for consumers, which supports discretionary spending power. This explains why XLY, consumer discretionary, climbed 1.84%, while utilities barely moved at 0.24%. The real economy is stabilizing. Earnings beats from tech companies reflect productivity gains that flow through to consumer confidence and spending patterns. Gold remains stubbornly flat at plus 0.03% despite the broader rally, suggesting safe haven demand isn't elevated. TLT, long-duration bonds, gained 0.18%, showing some defensive positioning but nothing urgent. Bond, broad fixed income, dipped slightly, while high-yield funds rose 1.26%. The safety trade is light. Investors aren't fleeing to safety en masse, which means the rally isn't fueled by panic selling elsewhere. Portfolio defense looks adequate without being excessive. The hero today is the diversified portfolio that's positioned for both growth and stability simultaneously. The villain is complacency, the belief that 69% yields mean risk-free money, when inflation remains sticky enough to keep real returns modest. Tech earnings are validating the narrative, but oil's crash warns against overconfidence in any single sector. The data is signaling a transition phase. Volatility is cooling, fundamentals remain solid, and capital is flowing where it should, into growth engines that have proven they can deliver even through uncertainty. The Canary dashboard shows technical health with physiological calm. This isn't a fever spike or cardiac event, but steady recovery. The verdict: hold positions while monitoring oil's next move as the final test of whether this rally has proper depth. Tomorrow brings either continuation or profit-taking, and only time will reveal which sector survives the rotation. The data confirms what we always knew. Portfolios win when they're diversified enough to weather any single storm.